Okay, for the second question, which is E6-9, income statement effects of unrealized profit. So Holiday Bakery owns 60% of Farmco Products company stock. During 2008, Farmco produced 100,000 bags of flour, which is sold to Holiday Bakery for $900,000. On December 31st, 2008, Holiday had 20,000 bags of flour purchased from Farmco Products on hand. So Farmco prices its sales at cost plus 50% of cost for profit. Holiday, which purchased all its flour from Farmco in 2008, had no inventory on hand on January 1st, 2008. So Holiday Bakery reports income from its baking operation of $100,000, and then Farmco Products reported net income of $150,000 for 2008. So A, we are required to compute the COGS that will be reported in consolidated income statement. And then B, we are asked to do the elimination entry. And then C, we are asked to calculate the amount reported as consolidated net income, and then income assigned to controlling interest. So if we want to calculate the COGS reported to the consolidated income statement, so remember that the COGS reported in the consolidated income statement is the COGS that has been resold to non-affiliate. Okay, so for the COGS reported, for the COGS on the inventory on hand column, it cannot be reported in the consolidated income statement because it is still inside the company. So what we can report is the COGS that has been resold to non-affiliate or to the third party outside the company. Okay, so before that we need to make the table, okay, the inventory table. So this is the table. Okay, for the sales 900,000, it is from the intercompany sales between Farmco to Holiday Bakery. Okay, so it's 900,000, and then the next data that we have is Holiday had 20,000 bags of flour purchased from Farmco Products on hand. So the ending inventory that Holiday still had at the end of the year is 20,000 bags. How many is the amount? So we need to find first how much is the price per unit. So it's simply 900,000 divided by 100,000 bags. So one bag will be $9. Okay, so $9 times 20,000 bags, it will become $180,000. Okay, so for the sales that has been resold to non-affiliate is 720,000. Okay, so we have filled these three we have filled for all the cells in sales row already. Okay, and then Farmco prices its sale at cost plus 50% of cost for profit. So it means that the gross profit is 50% from the COGS. Okay, so if this is still blank, okay, so we can make it as C. Okay, so 900,000 and then minus C, it will be 0.5 C. Okay, then 900,000 0.5 C plus C, so 900,000 equals to 1.5 C. C equals to 900,000 divided by 1.5. It is equal to 600,000. So that's why here the COGS is 600,000. Okay, so the gross profit, it is 900,000 minus 600,000, you will get 300,000, or it's 50% from the COGS, then it will be the same also, 300,000. Okay, so after that you can calculate the the gross profit percentage markup on sales. Okay, so it is simply 300,000 divided by 900,000 times 100%. You will get 33.33%. So if you apply to the next two columns, you will get the gross profit of 240 for the result to non-affiliate column, and then 60,000 for inventory on hand column. Okay, and then you can fill the COGS already. Okay, so this is what we want to find. Okay, so the COGS reported in the consolidated income statement equals to $480,000. Okay, so remember, if you want to find the COGS that is needed to be recorded in the consolidated income statement, then it is on the center cell. Okay, and then B, we are asked to do the elimination entry. So it's simple: debit sales, credit COGS, credit inventory. So again, for the sales, it's always from the first cell. Okay, and then for COGS, it will be the sum of 720 plus 120 become 840, and then for the inventory, it will be the deferred gross profit of 60,000. And then C, we are asked to calculate the consolidated net income and then income to non-controlling interest. So Holidays Bakery net income is $400,000. Okay, and then for consolidated net income, it is the sum of both companies' net income. Okay, so Farmco's will be 150. Remember that we have deferred gross profit that must be minus from the consolidated net income because it has not been realized yet. So I put it here. 150 minus 60,000 will become 90,000. So the consolidated net income will be 490,000. Okay, and then in order to find the income to controlling interest, we need to minus income to NCI. So how to find the income for NCI? It is 40% of 150 minus 60,000. Why? Because if you notice that this is an upstream sale. Okay, so for upstream sale, remember that the deferred is distributed to the parent and the NCI also. That's why the basis is 40,000 times 150,000 minus 60,000. If it is downstream, you don't need to minus 60,000 because all of it already given to the parent company. But because this is upstream, so you need to minus with the deferred gross profit. Okay, so 40% times 90,000, it will become 36,000. So income to controlling interest will be $454,000.